Hi everyone, welcome to Tuesday. We're back from holiday, so we're back into taking a look at the performance of the New Zealand stock market. So every Tuesday, we take a look at the NZSX 50 and how it's been performing, and then every Thursday, we do a share and review. So if you've got any questions regarding the share market, or if there is a share that you would like me to review for you, send me the ticker code. I'm more than happy to do that. Or just send me your questions and we will address those as well. Now, coming up on Thursday, I'm actually going to do a YouTube live, and that's where you can ask me anything, whether it's to do with share trading, investing, whether it's paying off debt, anything you like. So jump onto that. I would love to see you there. If you're unable to make it, because I usually make it at around 10:30, send me your questions in advance and I will address them there for you as well. So anyway, let's take a look at how the New Zealand Stock Exchange has been performing for the last couple of weeks. Just remember that this is for educational purposes only, definitely not intended to be personalised financial advice. If you're looking for that, then you do need to go and have a chat to your own financial advisor. Okay, as you can see, I have got the S&P NZSX 50 up here on the screen, which obviously is the main board for the New Zealand Stock Exchange. And if I look here for last week, look at that candle. That is a very large downward candle for the week. And if I look down the bottom, there is a lot of volume on there as well. That is quite a negative sign in that regard. The only thing that's positive about this is the fact that it's got a tail. So it means that whilst the sellers were definitely in control, the buyers were trying to wrestle it back, and they were the ones trying to drive that market up a little bit higher. But it's not a good sign. And the thing too is we've had two candles in a row now that have been negative weeks. If you watch me regularly, I do not enter any new trades if we've got two negative weeks in a row. That could obviously change, who knows, because at some point we always have tops and we always do have bottoms, and I certainly don't try to pick those. However, to me, when I see two red candles in a row, exactly like what I've got here, I will not go any further, and especially when we've got such large volume. And you can see here that for last week, we had $176 million worth of shares traded just on the main board. If I go to the week before, that was only about 43 million worth of shares traded. So we've more than tripled than what previous weeks have been. So that is a very, very big concern. Let's jump over to the yearly chart, and that will put on daily candles. And you can see here that Thursday, Friday were down. Wednesday, we obviously had a positive. Tuesday was negative, but look at Monday. That's huge. That is a very big drop on that particular day. So again, that is a real negative for me. Now let's put on our moving averages and just see what they're telling us as well. So remember that this is on the daily, so I'm going to use the 30 exponential. So it's going to bring up a 30-day moving average, and you can see here that basically the market fell below that 30-day moving average back on Monday, and it's now trending downwards. So that too is very negative. We will also put on the 15-day moving average and make a comparison with that. And look at that. So on roughly Monday, you can see that that blue line being the 15-day moving average has crossed through that 30, and the share market is trading below both of those. Very, very negative. And I would say to anyone, proceed with caution, because this is what we refer to as a dead cross. Definitely not a time to be in the market when any share market or any share that you're looking at looks like this, where those moving averages have crossed, they're trading to the downside, and the share, or indices in this case, is trading below those moving averages. I definitely stay out of the market. I do continue to hold, however, any shares that I have got, because there are sometimes some that will be counterintuitive and outperform the market. However, I definitely do not look to enter any new positions. Let's go and have a look at the 5-year chart, and you can see, if I zoom in, that the blue line is the 15-week moving average and the red is the 30, and the market has crossed to the downside yet on the weekly. However, they are both pointing down. And again, like I just said, the market is trading below both of those. Definitely cautious signs to look out for. So that's really where we're at the moment. There is a lot of caution out there. I know the US markets have sold off. So too is the Australian market. There's certainly been a lot of selling there. A lot of markets are under a lot of pressure at the moment. Now, if you're investing, I'll stop sharing. If you're investing into the likes of your KiwiSaver, for example, highly likely you're seeing that volatility happen there as well. The best thing that I can recommend that you do for your KiwiSaver is stay the course. In other words, no matter what fund you are in, leave it. Do not touch it. And I heard a really good quote the other day, and it said something like this, that the more you touch your shares and your KiwiSaver, it's like a bar of soap, the smaller it gets. So that's why I always say to people, when markets have already started to fall, you've just got to sit tight. You've got to ride it out, especially for those KiwiSavers. If you're holding your own existing shares, make sure that you know where your exit level is and abide by it. Don't try to pick the bottom or the top. Just abide by those stop losses. And I'm happy to help you out with that if that's something that you would like to know a little bit more about or learn. I've certainly done a lot of videos using stop losses. So like I say, KiwiSaver, stay the course, do not touch it. A good time to review your KiwiSaver is actually when markets are going well. And in my experience of 20 years being a financial advisor, I've always found that when markets are going really well, people are more than happy with their risk profile. They're more than happy with the likes of their investments. It's when markets turn south, but it's too late then. You need to ride it out because, like I said before, the more you chop and change, so even if you were going to go from a growth investment now and put it into a conservative fund, for example, you're actually selling those shares at a loss. Potentially, you could be buying some of those bonds or fixed interest at a bit of a premium. And then if the market turns or when the market turns, you're then potentially selling those bonds at a loss and buying into the shares at a bit of a premium. So remember too, with your KiwiSaver, if you're contributing regularly, if you're on a wage or a salary, you're buying units into the fund, and that is exactly what it derives the value of your KiwiSaver. It's the value of those units. So when the markets are down, you're buying more units. And obviously when the markets go up, you're buying less units, but the value is calculated on those units held. And that is how you can potentially do very well, providing you stay the course. Like I said, if you're unsure, reach out. Happy to help. So come back on Thursday. I've actually done a video on a new listing, which is Tyco Minerals, and we will take a look at that and see how that has actually been performing. But like I say, any questions, sing out. If not, hopefully we can see you live on Thursday morning as well. So until next week, take care.